Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, Apple boosting its investments in the U.S. We'll break down what you need to know as Tim Cook plans to join President Trump at the White House today. Plus, Disney reporting results that topped estimates. It announced a deal with the NFL as well. We'll have details on that and reaction. And Uber announcing buybacks of $20 billion after issuing an upbeat forecast. All that and more coming up on Market Catalysts. Let's get a check of the markets here. We are seeing a mixed picture right now. The Nasdaq holding up pretty well. It's up about 0.25%. The S&P up about 0.5%, but the Dow falling today, down about 26 points, 23 points, call it. And that's as we have some sort of mixed reaction to some of the earnings that we've been hearing about. And we do have some breaking news, maybe, from the White House. President Trump imposing an additional tariff on India of 25%. It looks like that's on top of the 25% that has already been imposed on India. We'll get you more details as we have them. Apple shares, in the meantime, popping after the White House announced that Apple is committing to an additional $100 billion investment in domestic manufacturing. Apple CEO Tim Cook will join President Trump in an event this afternoon. That's according to a White House official. We've got a panel of experts on this. Kimberly Forrest, Boca Capital Partners founder and chief investment officer, Yahoo Finance senior reporters Dan Howley and Ben Werschkul. Ben, let's start with you. So what are we hearing from the White House about this announcement?
Yeah, so this announcement will be coming this afternoon at the White House, and the parameters here, according to a White House official, are that Apple is increasing its investment in the U.S. We knew about $500 billion. This is essentially a $100 billion topper on that to bring its new total to $600 billion, which the timeline here is over the next 4 years. For that previous $500 billion and this new $100 billion, i.e. during President Trump's term in office. The focus here is what's being termed a new American manufacturing program, the focus on supply chains and critical components in the U.S. So kind of continuing Apple's promises of investments in the U.S. over the next coming years to kind of onshore its various manufacturing. No word on exactly what products would be part of this, but it's about supply chains and what the White House is terming critical components. As you mentioned, Apple CEO Tim Cook is set to be in attendance. This will be at 4:30 in the Oval Office with reporters there as well.
And Dan, obviously we don't know all of the details of this, right? But we do know what Apple had already committed, which I believe is a $500 billion investment. So this would take it to $600. And what were the plans for those funds thus far, in as much as we know the details?
Yeah, there was the planned kind of move where they're working with partners to build an AI server factory in Texas that would power Apple's Apple Intelligence capabilities for the cloud. There was also kind of a manufacturing learning program they were setting up, and obviously a number of pieces of production in the U.S. when it comes to Apple TV Plus and or Apple's movie efforts. So there was a lot of conversation as to whether that $500 billion was already kind of earmarked and not necessarily new that Apple would be spending. We'll have to see what this is, what kind of the consensus is around this extra $100 billion. But this is obviously all tied to the tariffs on India. Apple sources a large number of iPhones destined for the U.S. In India. They moved there to kind of avoid the tariffs on China that originally come out. And they've been kind of the target of the Trump administration's ire since then, basically having the Trump administration say, look, you have to build iPhones in the U.S. Experts say that, look, that's just not going to happen. We don't have the manufacturing, the skilled manufacturers, workers here. We don't have enough workers here for something like that. The automation would be incredibly difficult to stand up. And we also just don't have the supply chain set up to support that kind of effort. So in addition to that, building a factory, getting it staffed up, and then have it produce iPhones would take longer than the Trump administration would be in office. So, there's been all of this kind of go around. There's been experts who have said, who have tried to do this in the U.S. and say it's incredibly difficult. even a company like Apple would struggle. So, there's this ongoing back and forth, and it appears this is part of that Apple's effort to kind of offer an olive branch to the Trump administration. He also criticized them directly when he was over in the Middle East, when he was praising NVIDIA for their investment in Saudi Arabia and the United Arab Emirates, basically saying, Tim Cook wasn't there, but Jensen Huang was.
And Kim, let's bring you into this as well, because, between sort of trying to play nice with this administration and the sort of business case for building out infrastructure in the U.S., what do you think? Do you think that this is a good move, maybe a necessary move even for Apple?
Well, I think I'm not an apologist for any political party. Let me make this perfectly clear. But over the last couple of days, it looks like the Trump administration is trying to rapidly incentivize people to move operations away from China, probably away from India, because they're not playing in the tariff game, but to move things onshore. And that includes semiconductors, which we haven't gotten details on there. The drug manufacturing surely looks like it's being given 3 years to ramp up as the proposed tariffs kind of get harder and harder every year. So this isn't necessarily a surprise kind of announcement that Apple would be the, we'll say, object of the Trump administration's focus for moving some manufacturing, no matter how small, onshore. Probably to not only move their supply chain here, but also incent other computer and consumer hardware manufacturers to consider moving at least onto this continent, if not into the United States.
Right, sure, because Apple is a leader in most things. Kim, Dan, you're going to stay with me. Ben, thank you so much for updating us on this developing news. And we got to turn now to AMD. Advanced Micro Devices shares they're under pressure. It did have an upbeat forecast for AI spending, but that failed to offer clarity on the outlook for China sales. AMD CEO Lisa Su said they didn't include any revenue for the MI308 chip in the third quarter guidance. That's the one that goes into China, because the licenses are still under review. And this coming after NVIDIA said last month that the U.S. would be granting licenses to ship AI chips to China. My panelists, Dan Howley, Kimberly Forrest, still with me. Dan, when you looked through the earnings, and you sort of were figuring out what your takeaways were, does the China stuff sort of overshadow what seemed like a good quarter?
Yeah, I mean, that's really kind of what hurt the operating income, right? Why they saw that operating loss for the quarter. I think one of the other issues just being that the PC side, the gaming side, seemed to do rather well, while the AI side, the data center side, just kind of met expectations. So I think, when it comes to a company like AMD, a lot of investors want it to be the next NVIDIA, and it just doesn't appear to be doing that at this moment. But they do have their MI355, MI350. Those are coming. Those are to compete with NVIDIA's Blackwell chips. And then obviously we have the MI400s coming. Those would also compete with NVIDIA's higher end chips, the Vera Rubin, in the future. And so I think that's really kind of the biggest issue here is I was reading some of Bernstein's notes this morning, basically saying that, look, the outlook for data center doesn't really impress the street when, they're anticipating the kind of explosive growth that they saw out of NVIDIA. But, NVIDIA is the leader in this space. AMD is trying to catch up. They also, while doing that, have to convince customers that they should buy their chips, not just NVIDIA's.
Right, definitely. So that's sort of the underlying story here. And this brings me back to a comment I read this morning, Kim, from Jordan Klein over at Mizuho, who tracks the tech stocks. And he said, who really owns AMD or NVIDIA just due to upside from sales back into China that had been blocked by Trump. He's saying that's not really the story here. So is that how you feel about AMD too? And sort of how much room do they have in that data center business?
Sure. Well, I think that they have a lot of room. And yeah, it would be nice for them to be able to sell chips today. But if you're owning a stock, and we own them for 3 to 5 years, so we have a longer term view, our view is that AMD is the closest thing to be able to compete against that Blackwell chip. Now, they have a couple of really important hurdles to get over. The first is just basic data center hygiene. Data center managers like to have everything uniform and the same because things are always breaking. They have to be able to understand, the parameters of the chip. What does it look like when it's going to break? How can we whip that board out, slide a new one in, and get on with our jobs? So that is the first hurdle. The second hurdle is NVIDIA's name brand. In my note that I wrote earlier today, this really, to me, feels like the dot-com era, where any kind of goofy idea could get funded as a dot-com if they had two things. If they specified Oracle was their database and Sun Microsystems was the servers that they were going to run on it, because that tech stack looked like you knew what you were doing. And in today's funding world, I am sure nobody's out there saying, hey, we're going to give a whirl with these AMD chips because they're probably as good and cheaper, and that's good. I'm sure every new AI idea is specifying the NVIDIA as part of its tech stack. So these are the things that AMD has to overcome. But I think they can because of their product knowledge, and they have financial latitude to, last as long as it takes to kind of chip away at that market.
So, Kim, all of that said, do you want to own AMD over NVIDIA, or you still got to own both of them?
I think you have to own both. NVIDIA's today, and AMD has the potential for tomorrow.
Makes sense. All right, let's move to another story within this general universe that we're talking about. OpenAI. There's reported in early talks for a stock sale at a $500 billion valuation. That's according to Bloomberg reports. Dan, obviously there is this huge sort of war chest arms race within AI. We've seen OpenAI get some of its talent snatched away by the likes of Meta. And so now they're, building up the funds again to spend on infrastructure and talent, I guess.
Yeah, I mean, look, this is part of getting the employees that they have to want to stick around, and then entice new employees to come on board. They're still the leader in the space, OpenAI. They dominate. They're just the household name. They were the first ones to really come to market with ChatGPT, and they're the most used of those kind of Gen AI apps. But that being said, they're not without competition. You have, obviously, you alluded to Meta kind of poaching some of their top talent. Meta's doing that to seemingly everyone, or at least trying to. You have Perplexity building out. You have Anthropic building out. Oh yeah, Google. And so all of these companies continue to try to get as many workers as they can to get or sustain the lead they have in generative AI. And, OpenAI, obviously, they use Microsoft's infrastructure. They also use Oracle's infrastructure, but they still have to pony up for that. And so this will help them ensure that they, A, continue to attract top talent and then keep them, and then B, continue to be able to offer their products and then build out their ability to serve up those products as well.
So Kim, we're talking about, AMD's run and what's priced in to both it and NVIDIA. And obviously OpenAI isn't public, but how does it live up to a $500 billion valuation while still in the private market?
That is an excellent question. Although private markets are just as unsustainable as public markets are for a while, just, the crazy ideas, they get bought. My cautionary moment here for AI, and let me tell you, I am a huge believer in AI. I was a software engineer in the 90s. I worked at AI companies, including, neural networking, tool development, the whole thing. I believe in its ability to add productivity. But currently, the companies like OpenAI that say, hey, we're smart, but just trust us, and we're going to do this AGI thing, we don't know what it is, but here, give us money. I think that's all well and good. But the thing that I learned from my days in tech is identify the problem that a technology solves, what the cost of that is to deliver, and versus the problem that it's solving, the cost of the problem. And the delivery, the cost of the solution has to be less than the cost of the problem. And that $500 billion to me just smacks of, trust us, we're going to build it and the problem will come. And I don't believe it. I would not, it's hard to say, but this could be a moment where we're just throwing money and hoping for the best, and that's not a great strategy for investing.
So Kim, just quickly then, what does this sort of worst case scenario look like? Or even not worst case, what does this sort of meh scenario look like?
Well, the meh scenario has played out over and over again with 3D printing, with the latest has been autonomous driving. What investors' biggest issue is with investing in a new technology is not giving it enough time to be developed and mature for the real world. Like in 2015, 2016, everybody was saying driving cars are around just around the corner. Well, 10 years later, we're finally getting to it. And it's not a pervasive rollout. It's a good rollout, right? And there's some other areas that, not just robo-taxis, but I think long-haul trucking is going to be a thing. But again, this has taken 10 years to be right around the corner. And I think that is what could happen. Investors could weary of all this money being spent and returns not being seen. And that could then make all of this the valuations crash, not necessarily the companies or the idea. It could slow the build out for sure if the investors won't, throw more money at it. But new technology, look backwards and see what happens. And it often happens this way, where there's a flush at the beginning, a rush to get out, and ultimately, it does deliver, but in different ways than we had anticipated originally.
Yes, unintended consequences, unexpected consequences. We'll see what they are. Kim Forrest, Dan Howley, thank you very much. Appreciate it.
Thank you.
Coming up, we got a deep dive into what's next for Disney, including the company's upcoming ESPN streaming service. That's next. Disney shares falling nearly an hour into trading, even after the company raised its profit guidance for the full year, driven by strong results for its parks and streaming businesses. Linear did lag. Joining me now to break down the biggest takeaways from the report is Geetha Raghunathan, Bloomberg Intelligence senior media analyst, and opening bid host Brian Sozzi. Saz, I want to start with you because you talked to Disney CFO Hugh Johnston specifically about ESPN's deals with the NFL and WWE ahead of the launch of its standalone streaming service on August 21st. So what stood out to you?
Well, Disney checked a lot of boxes here, Julie. They came out, beat on earnings, that's good. Raised their guidance, that's good. Maybe not as much as some people would have liked. Fiscal year 2026, Disney, I think, recommitted to double-digit earnings growth. Didn't precisely say that on the earnings call. I couldn't get Hugh to tell me that. But again, he strongly hinted that they're going to hit that guidance they put out there a couple months ago. But again, Julie, like you mentioned, big day for deals. NFL deal, new $1.6 billion 5-year deal for WWE. I asked Hugh Johnston, Disney CFO, about the importance specifically of this NFL deal.
We feel terrific about the assets that we'll be getting for the deal. The combination of the NFL network and all of what that brings, in addition to that, combining our fantasy football business with the NFL's fantasy football business, plus the ability to market Red Zone. Overall, we feel terrific about that. And obviously, there's 3 additional games we'll be getting as well, which are of significant value to us.
Julie, you and I have heard for, 10 years that Uber's trying to create a super app. Tesla's trying to create some form of super app or super platform. I mean, Disney's giving us a sneak peek of a potential consumer sports super app. Now all they need is Wingstop on the platform. But maybe they hinted at that, Julie. Hugh's saying that there will be commerce on the platform. Maybe I could order wings, play some fantasy, and then go buy some NFL merch as well.
But you need to do your banking on there.
Well, that's next, Julie.
All of the things.
Brian Moynihan, where are you at? Bank of America. Give Hugh Johnson a call.
Geetha, what do you, I mean, there's so much in here, right? Take the company itself and just the quarter and all the different lines of businesses. Then you throw the NFL, ESPN thing on top of it. I guess given that the shares are down, where do you think maybe Disney is not up to snuff here?
I think the 2 biggest things in the narrative, Julie, we're looking at the streaming business and the parks business, and you spoke about that, and both of those did really, really well. You had the domestic parks where there has been some concern, from macroeconomic factors, from the opening of Epic Universe, which was Comcast's biggest park in Florida, about whether that competition would kind of pressure attendance. But we didn't see any signs of that. So real resilience there in the parks unit, in the streaming unit. The share reaction is a little bit of a head scratcher to me because they did post solid results across the board. They did, as you just pointed out, beat and raise guidance. Again, maybe the guidance raise was not as much as people were hoping for. The one thing, of course, that got my attention was that they did say that they will stop reporting subscriber numbers for Disney Plus. This is again them following pretty much the Netflix playbook as everybody kind of starts shifting away from subscriber growth and kind of focusing more on profitability and EBITDA. So I'm not really sure whether that is necessarily throwing off investors, but of course it's not a great look in terms of transparency.
Did you like the NFL ESPN deal and the WWE deal? Do you think that I mean, the company says it's going to be accretive. Do you think that that is a positive step?
It's absolutely a positive step. I mean, they're launching their ESPN product on the 21st. They need content. They got that with the WWE deal. Now, this is something where you know that you have a hardcore, base of fans. It was extremely beneficial to Peacock. We know they reported huge increase in subscriber numbers when they got all of that WWE content on board. So this coming back to ESPN is definitely great news. And from the perspective of the NFL, I mean, this is a great way to future-proof the ESPN business. You have great content, of course, with the Red Zone, with the NFL Network. But then remember, the NFL also holds the cards with all of its media deals because they can opt out of their current 10 to 11-year agreement at the end of the 2029-2030 season. And basically, now we don't think that is going to be so much of a risk for ESPN. For the others, which are Fox, CBS, Amazon, we're not so sure.
Geeta, I would love to get your take on this. If for those who are maybe trying to handicap who could succeed Bob Iger, it didn't become any clearer on this front after this news. You have Josh D'Amaro, bang-up quarter for the experiences and park business, sales up 8%, operating profit up 13%. Check done. Those parks are being built out even more with more new rides and experiences. But with these new content deals, you have to think maybe Dana Walden, who has just incredible content experience, gets the nod as well. But I'd love to get your take on that and who might be leading here.
Unfortunately, I don't have a whole lot of insight. I mean, this has been this constant question with Disney. I mean, the succession question. We know Bob Iger is definitely going to be there through the end of 2026. After that, of course, it's anybody's guess. Yes, you point to Dana Walden. I think she is a name. Her name has kind of bubbled up a lot just because of the emphasis that Bob Iger has always kind of placed on the content division. He's really kind of energized, reinvigorated that whole content engine. So yes, I also give her the edge. But again, I don't have any specific insight.
Well, you got to keep waiting, unfortunately. Geeta, good to see you. Brian, thank you very much also. We got much more markets action coming up. Stay tuned. You're watching Market Catalyst.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ. Let's get a quick check of the latest market action about 1 hour into today's trading session. We're seeing all three major indices, a bit of a mixed picture here as we make our way into today's trading session. The Dow moving lower about 0.2 percentage point after Trump said that he was going to raise tariffs on India to 50%. Also, investors still trying to understand where we're at with that weaker than expected data that came from the ISM report that's pointed to some weaker jobs reports or jobs data that showed some stalling in hiring among employers here. The NASDAQ gaining about 0.2%. When you look at the intraday trading day here, staying in the green so far this morning, really led by Apple. And we'll take a closer look at that stock in just a second. But the S&P 500 also moving higher, up about 0.1%, really accelerating off of those losses that we've seen in recent days. Keeping a closer look at the Dow here, if we take a look at equal weight, what we see really leading the way here is Apple. That's up about 4% in these early hours of trading here. This comes after the White House said that Apple is expected to boost its U.S. investment commitment by $100 billion. That's on top of the $500 billion that pledge that the company already made earlier this year. Another stock that we're seeing in the green moving higher this morning is McDonald's. That company reported its second quarterly results, and we saw a beat across all major metrics, adjusted earnings, revenue, and same-store sales growth, including a reversal here in the U.S. with same-store sales growth up about 2.5%. There's lots of optimism moving into the second half of the year. As you could see, that stock up about 6% year to date, really jumping off of the lows earlier this year after they got the impact from that E. coli outbreak. I also do want to hit on Disney, and that's really leading the laggards here, down about almost 3.5% as we make our way into the trading day after they announced that the NFL will get a 10% stake in ESPN. They're also gearing up to launch that direct-to-consumer app on August 21st for ESPN. They did raise their full-year forecast, but it looks like investors were looking for more there. I also very quickly want to hit on AI. What we're seeing there is really this play where we're seeing Supermicron lead the laggards here, down about 20% after they missed expectations and posted a weak quarterly earnings guidance. Also in the red this morning, Snapchat, they missed expectations and said that their average revenue per user, that missed what Wall Street was looking for. And AMD also in the green this morning after they did not include their chip sales to China within their Q3 guidance. Similar story, or rather different story than what we heard from NVIDIA earlier this month. All three major indices, though, mixed picture here, but keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout today's trading session.
Now time for some of today's trending tickers. We are watching Astera, Klaviyo, and Unity. First up, Astera Labs hitting a record high today. The semiconductor manufacturer reporting second quarter revenue and adjusted earnings per share that beat the average analyst estimate. Citi analysts say they're reassured by the company's continued demand strength across all of its segments. Those analysts boosting their price target to $160 from $100, but the shares, they're above that, both of those today. Next up is Klaviyo. Those shares are rallying after the e-commerce, SMS, and email marketing company announced a strong outlook for the third quarter. The company's second quarter results also beat Wall Street's expectations. The company has 17 buys, 3 holds, and no sells, and those shares are up 16%. And finally, we got Unity Software reporting second quarter results that beat expectations. Those shares, though, they're falling today. The company did provide a third quarter revenue outlook range that could be weaker than Wall Street had anticipated. Citi analysts saying even though the results beat expectations, the outlook could weigh on the stock, especially given recent strength. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, Uber topping second quarter revenue estimates and issuing an upbeat forecast for the third quarter. The rideshare company also announcing a $20 billion stock buyback, but the shares are under pressure. Joining me now, John Blackledge, TD Cowen Managing Director and Senior Research Analyst, and Yahoo Finance's Pras Subramanian. Pras, let's start with you. What are the top takeaways from these results?
Yeah, I think overall, I think it seemed like a pretty strong quarter. Revenue up 18% year over year, adjusted EBITDA up 35% to $2.12 billion. Monthly active platform users up 15%, 180 million users there. Kind of gives them confidence, they said, to announce this $20 billion share repurchase plan you mentioned. But the stock is up like 50% year to date, so shares aren't exactly cheap here. Maybe that's why you're seeing some of the movement a little bit downward here. But they also upped also their guidance for Q3 better than expected. So seems full steam ahead here for Uber. I think the business is sort of rolling on strong here as we go into the back half of 2025.
John, what do you think here? Is this just a valuation issue that's seeing these shares under pressure?
Yeah, I mean, it's up, almost 50%. It was a great quarter. The guide was great. I think one thing that I will call out was this record number of monthly users, 180 million monthly users, and it's driven by a number of things. Low-cost products, premium products. They're targeting different demos, household income, different age groups with the teen accounts and senior accounts. But there's actually still a lot of runway to go. One thing that they called out in their top 10 markets, only 20% of their annual users are monthly users. So a lot of runway for user growth. And even going back to the IPO 2019, we thought the model would be driven by users and frequency. And you're seeing it here with the record number of users, and that user growth at this scale is pretty phenomenal.
John, if I understood correctly, they also said only 20% of users use both mobility and delivery, which was something I was actually pretty surprised about, right? That I assumed kind of if people use one, they tend to use the other. So are you pretty confident in their ability to get those numbers up as well? And how key is that going to be to growth going forward?
It's definitely big. And they made one call out. I think 30% of new Eats customers come from the Uber Ride app. That's something they're definitely focused on. And it's actually one of the areas that could drive margins even higher. It helps with customer acquisition cost. But yeah, Dara was a focus on the call, and I think they'll drive that further. And remember, they're in about 70 markets for mobility, about 30 for delivery. So there's 30 markets that overlap, and so yeah, that should continue to grind up higher as they focus their efforts on that.
And Pras, one of the other themes that, of course, is emerging, not just with Uber, but with its competitors, is the whole autonomous universe now. And Dara on the call really emphasizing it's early days still for that, but he did talk about some of the partnerships here. What should we be focused on that front?
Yeah, I mean, there's a big initiative there to kind of go back into the robotaxi business, working with Lucid and also a company called Neuro, which has the autonomous OS sort of software. I spoke to Lucid's CEO yesterday and talked about how they're really excited about this deal, and it's for a minimum of 20,000 EVs. They say it could even be more, and that's sort of part of their package. And they think that Uber, sort of selected them because they were the best in breed. Well, that's an argument we can have later. But the bigger picture is that Uber is definitely leaning into the robotaxi sort of segment here as they see Waymo take off, Tesla in the space as well, trying to get their offering in that. But Julie, I know we talked about this earlier too. They're also doing things like adding the ability to add women drivers for when customers or depict the gender of your driver. I think that's a good thing. But we also saw a New York Times report today, right, about how it's a growing liability issue for Uber, that they're sort of maybe dusting some of these things under the rug as they try to grow.
Yeah, the headline on that New York Times article, Uber's festering sexual assault problem, not what you want to see when you come out with earnings, for sure. And I should mention Lyft, by the way, a while ago introduced the option to have female drivers. So Uber's actually following on its heels in doing this. John, I did want to ask you, I'm not going to ask you about that. I am going to ask you about the AV piece of all of this and kind of where Uber fits in and how big that market is. In other words, is it going to be a sort of winner takes all, or is there lots of room for AV in the future?
Yeah, they have 20 AV partnerships across mobility, delivery, and freight. They're going to do 5 AV deployments in the back half of 2025. They're in, as they say, year one of this 10-year transition. We do not think it's winner take all. And kind of our house view at TD Cowen is that Uber and Lyft will be the demand aggregators for AV over the long term. As the leading rideshare marketplaces, they can maximize the utilization of the expensive AV technology. And just if we click to Waymo, which is exclusively on Uber in Austin and Atlanta, just take Austin, for example, which launched in March. They're already expanding the geo zone. They're adding hundreds of vehicles. And Dara said it's having a halo effect on rideshare in Austin, meaning it's increasing the TAM for rideshare. There's certainly a novelty part of it, and particularly for tourists in Austin. Zooming back out, they have a number of partnerships, AV partnerships globally. We don't think it's going to be winner take all, and it will be kind of positive for the rideshare industry over the long term.
And John, bottom line, when it comes to Uber and the fact that it's already had this big run this year, is trading near a record, what do you think propels the next sort of leg of growth for the stock itself?
Yeah, I mean, there's probably maybe a little bit of upside to numbers, and I think we can argue for multiple expansion here with where they are with the AV narrative. And the AV narrative for Uber has kind of ebbed and flowed since early last year, but they're in a really good spot with the number of partnerships that they're accruing and they're going to be deploying in the next year and a half. And so with their growth rate, I mean, EBITDA grew mid-30s. That's where it's kind of been tracking. We have I think like low to mid 30% EBITDA growth the next couple of years, and the EBITDA multiples at like 18 times. So you can kind of argue, or a little bit above that, you can argue for multiple expansion. And that's one way for the stock to kind of break out from the kind of 90 area and maybe drive upwards to 100 and 100 plus. Our price target's $104 right now.
John, Pras, thank you so much. Appreciate it.
Thank you.
We got much more markets action coming up, including your ETF report. You're watching Market Catalysts. Snap shares plunging Wednesday after reposting its slowest quarterly growth in more than a year. The photo-sharing app blamed the downturn partially on a glitch with its ad-buying tools, as well as competition from bigger rivals. Joining me now is Jasmine Enberg, eMarketer Vice President and Principal Analyst. Jasmine, thanks for being here.
Thanks so much for having me.
So Snap talked a lot about this ad glitch, which basically allowed its advertisers to be charged less than they should have been, and that was part of the issue. But talk to me about how you're thinking about Snap and how much of the issue that was.
Yeah, so even before earnings, I said that it wasn't looking good for Snap, and it was less to do with economic uncertainty and the tariffs, which of course Snap had warned about at the end of Q1, and more to do with sort of fundamental structural challenges within its business model and its ability to monetize, in part due to some of the large competition that we're seeing in the market. And I certainly could not have predicted that there was going to be an ad glitch in Q2, but I think that again points to some of these challenges that it has in its business that are much longer term. As you know, Snap has been working to revamp its advertising platform for many quarters now. A lot of that work has been focused on its direct response advertising platform. And I do think that perhaps in a different context, investors might have been just a little bit more forgiving, although maybe not quite so much because they're rarely forgiving with Snap. But this work has taken much longer than many of them have anticipated. I think investors are getting impatient because the results have been inconsistent. So there's very little room for mistakes. And then if you bring in the broader context of Meta's and Reddit's blowout earnings for Q2, it really shows that it's hard for Snap to shift any or a lot of the blame to macroeconomic headwinds. It pointed to Ramadan and the removal of the de minimis tax exemption as other reasons for the deceleration in growth. When you have these two platforms that are very different sizes, very different in terms of their importance to advertisers, really performing well in Q2.
And Jasmine, daily active users overall were up 9%, but there was some weakness in North America. Why is that happening?
Yeah, well, that is extremely troubling to me because North America is Snap's core market. It is where it has made most of its money. It's much harder for it to monetize in international markets. Now, on the call, CEO Evan Spiegel talked about how daily active users is usually a measure of communication on the platform versus entertainment. Snap, as you know, of course, is primarily a messaging app, but it also has a short form video feed. It's also focused heavily on creators. And so it seems that there is some weakness potentially there. Now, Snap also spent a lot of time talking about sponsored snaps, really hyping them up. It's a new ad placement that they have that will appear within the chat tab, which is the core part of the Snapchat app. And they're hoping that they can kind of help to turn around some of the weakness in its ad business. And they're already saying that that's, given some incremental reach to advertisers as well as conversions. So they're really betting on this communication aspect of the app. But again, the weakness in North America is extremely troubling because it means that Snap is going to be more reliant on international markets going forward to drive growth if it can't bring that back up to growth.
And Jasmine, if it is having these issues in its fundamental business, are glasses the answer, right? This, like smart glasses, is that something that's going to juice growth?
Well, AR overall has been such a core part of Snap's vision and its ambitions, and this isn't the first time it's introduced glasses or spectacles. Snap got a few questions on the call yesterday from investors really asking whether they have the resources or the capital to even bring these devices to market next year as promised without a partner. Executives kind of sidestepped those questions and, historically, they haven't done very well, but there is a lot more momentum right now for smart glasses. I mean, we saw demand for Meta's Ray-Bans, for example, grow last quarter, and that could either help or hurt Snap in this environment, really depending on what these glasses are when they come to market to consumers.
Yes, we'll see how that all works out. Jasmine, thank you so much for your perspective. Appreciate it.
Thanks so much for having me.
Coming up, we'll have your weekly ETF report brought to you by Invesco QQQ. We'll be right back. It is time now for this week's ETF report brought to you by Invesco QQQ. The iShares MSCI India ETF falling to session lows. That's after President Donald Trump announced he would impose an additional 25% tariff on goods from the Asian nation, that to be effective as of September 17th. The president imposing that additional 25% tariff on goods from India in response to its continued purchase of Russian oil. The announcement coming hours after talks between Washington and Moscow over the war in Ukraine failed to yield a breakthrough. Trump has escalated his fight with India over trade, unilaterally imposing a tariff rate after months of negotiations failed to secure a deal. He accused New Delhi of refusing to ease access for American goods and criticized its membership in the BRICS group of developing economies. The ETF, known by its ticker INDA, fell as much as 1% following the announcement, although right now it has backed up off of those lows of the session, perhaps because there is a delay until these tariffs do go into effect, which would be a total of 50%. So maybe some optimism that there is a little time to continue negotiations. And that is your ETF report brought to you by Invesco QQQ. Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst, first up, President Trump announcing an additional 25% tariff on India. We'll bring you the latest on the trade front. Plus, Novo Nordisk shares taking a hit as sales slow by the most in 4 years. We'll bring you the takeaways from our interview with the CFO. And Mountain reporting for the first time since going public. We sit down with the CEO to discuss its outlook as a public company. All that and more coming up on Market Catalyst. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here. We have been seeing some strength here across the board, even though things have been wavering throughout the session. But for now, the Nasdaq is up by 0.6%, the S&P up about 0.5%, and the Dow up 0.25%, just over 100 points. Earnings, one of the things that's helping propel stocks higher today. And speaking of earnings, let's talk Mountain. It reported results for its first quarter as a public company after its IPO in late May. The company showed double-digit growth in its performance TV revenue in the quarter, and adjusted EBITDA was up 92% from the same period a year ago. Joining Yahoo Finance for the first time since that IPO day, Mark Douglas, Mountain CEO, here with me in the studio. Good to see you.
Good to see you.
So the stock is just about double the IPO price, which was $16 here. We are seeing a little bit of weakness today. You guys are an ad tech business, effectively. And, you know, the ad business is really interesting right now because we're trying to figure out what's going on with consumer spending, therefore what are advertisers willing to spend. So first of all, give us just sort of your big picture view on that.
Well, I think one thing that's important to understand is there's really two ad businesses. So you have kind of, we'll call it the top 1% advertisers, like these big global brands who have, you know, decades long at this point relationships with media networks, and they operate in one way, which is, you know, fixed budgets decided well in advance and really to build those large brands. And then you have an entirely different ad business, which is basically e-commerce business, it's travel, but essentially direct response, which is Google, Meta, Mountain Performance TV. And that is essentially operates very differently. They're budgeting from revenue. The companies
are more reactive.
Right. I want to grow my revenue. And you don't pick up the phone and go call Google and say, I want to buy more ads. You say, I want more traffic to my brand.
Got it.
And so that's the business. And so both are actually doing quite well right now, but they operate very differently. Like in tough times, direct response tends to go up even more. Whereas in tough times, the brand business, that's the first thing they get cut. So what you're seeing is the media companies are definitely in a transition period. Advertising as a whole, I think, is very healthy in all sectors. It's particularly healthy in direct response, and you saw that reflected in Meta's results. Mountain, our ad business grew 35% year over year. Meta grew well, Google grew well. And the whole direct response advertising market is doing really well. We're excited about that.
And your performance TV business basically tries to better capture the result of advertising, right? The impact of advertising.
Right. So what we do is we take streaming television, which made TV now a digital channel, and meaning it can be targeted, it can be measured, and we brought all of the functionality that you need as a small and mid-sized business to now use television as part of your marketing mix alongside of probably the Instagram advertising you were already doing or what you were doing on paid search. And that just wasn't possible before we launched our company. And so and we've seen all these small businesses, thousands and thousands of small businesses now come to television for the first time. 97% of Mountain's customers have never advertised on TV before.
And we're talking about streaming TV specifically,
exactly. All streaming.
Which is very interesting. So the streaming transition has allowed all of them to advertise in that way for the first time.
It gave the building, it kind of gave the basic plumbing, and then we added all of the technology to say, well, who is your target customer, and when should we reach them, and what should the ad be, and how do we measure the impact? We brought all of that additional technology on top of the basic streaming capability, and as a result, we have partnerships with virtually every streaming network in America. All of the TV manufacturers like Samsung, LG, Vizio, Fast Networks, we're partnered across the entire ecosystem.
That said, as I mentioned, the shares are under some pressure today. They are up quite a bit from the IPO. You guys had EBITDA that grew. You're still posting losses. So do you think that there's an expectation from investors in terms of the path to profitability here?
Yeah, so we have EBITDA and adjusted EBITDA. Adjusted EBITDA is just take out stock-based comp. If you take out stock-based comp, we grew our adjusted EBITDA last year, I believe, was $38 million. It's $24 million in the first half of this year, and the second half is going to, we expect to be larger. So without stock-based comp, the company is very profitable. Even with the normal EBITDA, the trend line is clearly the company will be profitable, both on an adjusted EBITDA basis and an EBITDA basis. And we think both are important. But think of this way, is that if you just look at the operating business, the company is very profitable. If you put in one-time charges for the IPO, that was out of a $26 million loss, 23 million of it was a one-time charge for the IPO.
Gotcha. And when you look at the advertising business, is it still a proxy for economic growth? And if you're still expecting the business to do well in the second half of the year and beyond, what does that tell us about economic growth then?
Well, I think ultimately in the US especially, it's all driven by consumer behavior, and consumers are not pulling back the spend. I think people, the economy has grown well. I don't, in the direct response performance advertising business, if the economy is faltering a bit, the companies, all these small businesses, big and medium-sized business, even big business, they don't give up their growth aspirations. So they just look for more efficient ways to find their next customer. And those ways are, using performance TV, using, paid social and paid search. They're not like run Super Bowl ads. So it's that kind of big brand.
Because it is a lower cost way to get to consumers.
It's lower, and more importantly, it's much more precise. Like there's an old kind of saying in advertising, I know in kind of broadcast advertising and brand, I know I'm wasting half my budget, I just don't know which half. In direct response marketing, you're not wasting money. You are measuring the impact of every dollar you spend, and that's what companies want.
Are you seeing any weakness anywhere in speaking about sectors, of the economy or advertisers?
We really are not. I mean, we were like all companies. I thought we looked at, will tariffs affect how our customers operate, and it really didn't. I mean, even if for a short period of time you were a company affected by tariffs, I mean, you don't just sit back and say, I'm done. You basically immediately find new ways to grow, new ways to compete. And so, our business is broadly supported. We don't have any real revenue concentration. We're working with a lot of companies, and we're adding new companies literally every day. So I think in the grand scheme of things, it doesn't really matter what the economy is doing. We're adding customers at a very fast rate, and we expect to continue to grow nicely.
Interesting. Mark, good to see you. Thanks for coming
in.
Thank you. Appreciate it. Got much more markets action coming up. Stay tuned. You're watching Market Catalysts. Novo Nordisk is doubling down on direct-to-consumer offerings to both combat copycat compounders and satisfy lawmakers' demands for lower drug prices. In a surprise profit warning last week, the company warned that copycat compounds were affecting sales of its blockbuster Wegovy drug, particularly in the U.S. Here with more details on what we heard today, senior health reporter Anjali Kamlani. Hi, Anj.
Hi, Julie. That's right. We heard from Novo Nordisk today more clarity on that downward revision. If you recall, last week, the company did say it was expecting sales growth to reduce from 13 to 20% down to 8 to 14%. Big jump there. And then they did miss on earnings for the second quarter, so that was expected, reporting $11.95 billion compared to $11.97 billion. A majority of that coming from the GLP-1 sales from Ozempic and Wegovy sales. They did also miss on earnings per share, 5.96 per share compared to 6.06 from the street. And we know that this is also coming at a time when the company is feeling the pressure of competition with Eli Lilly, as well as the pressure to address the compounding market. They have doubled down, as you mentioned, on that market, saying that Ozempic is also going to be rolled out on that market this year, towards the end of this year. And that just shows how much they think of it. They have already said that 10% of the Wegovy market in the U.S. is cash paying, and so they expect that direct-to-consumer cash paying system to grow. I had a chance to talk to the CFO, Carsten Knudsen, and he did talk about that, telling me that he has full faith in this cash paying business and is going to grow. But it also comes at a time when the company, as I mentioned, under pressure, looking at the shift in the CEO, a company that has prided itself on having a handful of CEOs in its more than 100-year history, is now dealing with the reality of the pressure of this very profitable market. And so here's what Carsten had to say about that.
I was surprised about the change of CEO back in May. But I would say, looking at other companies and other industries, then it's not unusual to change CEO from time to time. And Lars has had a fantastic run for more than 8 years. And then other companies, when pressure's on in terms of performance and competition, then it's not unusual that boards and owners they assess what's the right team to lead the company from a given point in time. So in a macro setting, I don't think it's extraordinary, but in a Novo setting, it was indeed surprising.
Just highlighting how much Novo has had to pivot to address its position as a market leader compared to its past. And in addition, I also talked to him about, the programs that have been cut. There have been a couple of early stage products in the pipeline that they cut. In part, it could be to address sort of this reduction in sale and needing to show a little bit of profitability. But Carsten said that it wasn't exactly that. So here's what he explained.
The projects we stopped, we simply didn't see sufficient differentiation from what's already in pipeline or on the market to take it forward. So we'd rather close these trials and then prioritize our R&D efforts on other more promising trials.
So as you can hear, they're looking not just at that, but they also have their next gen GLP-1s in the pipeline as well, and a lot of focus on that, knowing that they have a market lead position in the weight loss market and the GLP-1 market to protect, and a lot of resources going there, it seems. Back to you.
Yeah, really interesting ongoing story. Anjali, stick with me here because we're going to talk about Hinge Health. Hinge Health reported a beat in second quarter earnings after the bell Tuesday. It's the first report since the company went public in late May. Revenues coming in at $139 million in the second quarter. That's a jump of 55% year over year. It also beat Wall Street's expectations of $125 million. Since going public, the company's stock is up more than 80%. Let's send it back over now to senior health reporter Anjali Kamlani, who's standing by with the Hinge Health CEO and co-founder Daniel Perez.
That's right. Thanks so much, Julie. Daniel, so good to see you again. The last time we were down at the exchange ringing that bell. Clearly some good news for the street today. You're beating, you've gotten some growth in, and considering this is the first earnings after the IPO, talk to me about how you're feeling about that and having to even have the visibility right now that everyone has into your books.
Well, look, we appreciate the transparency. We've been operating internally like a public company for multiple quarters pre-IPO, and we like to show that, there's a lot of potential here in digital health, and our vision is to use technology to scale and automate the delivery of care. And I hope this first quarter out of the gate shows that there's a lot of momentum at our backs, and that this is going to be a long process of using technology to scale what hitherto has been very manual one-on-one interactions with providers. And we're excited about the future ahead.
Talk to me about the growth in subscription, because that also drives your revenue. I know that has been part of the focus for many platforms like yours, and there's been sort of a test, if you will, and that's why the spotlight is on you. I recall down on the exchange floor, you and I chatted during the IPO. You said you got a number of calls from digital health companies because this was going to be proof in the pudding on whether or not the market is back and interested. What can you tell us about whether or not you're seeing that right now, and whether or not this growth that you're seeing in subscribers is sort of par for the course, or did it jump after the IPO?
No, I don't think the IPO had a big impact on our subscribers. I haven't seen that yet. I would say for digital health companies, you've really got to focus on being intellectually honest about what you're bringing to market. We try to make sure our products really improve clinical outcomes, that patients or our members love using it, and thirdly, that they actually save costs. If you do that, you're going to get a lot of enterprise customers, health plans, employers, fully insured plans, Medicare Advantage plans, interested in your product. And then secondly, if you build a delightful experience, members are going to sign up. They're going to choose you over their many other alternative options, including alternative in-person care options. And you've got to run a layer underneath all of that, a foundation of a sustainable business. And frankly, if you have a digital health company that's delivering on that triple aim in healthcare, which is experience, outcomes, and costs, and you're able to build a foundation of a sustainable business underneath that, then the markets are open for you.
I know that we talked about the growth. I want to talk about the one sort of cautionary flag in the report today, and that was the GAAP loss from operations, about $500 million there. What can you tell us about that and what you're expecting for the rest of the year?
When we go public, we issued a bunch of RSUs, or restricted stock units, before IPO. None of them vest. So as soon as you IPO, just a ton of RSUs that have been built up over multiple years vested. And so the reason the market somewhat, I think, I'm not the banker, has somewhat shrugged that off is because it's expected of a first earnings report when you IPO that you're going to have a ton of stock that's kind of built up over time just vest, and that's going to look like a very, very large GAAP loss. I think what a lot of investors are focused on, however, is our free cash flow, which was our non-GAAP free cash flow was $33 million for about a 23% non-GAAP free cash flow margin. And I think we're slightly ahead of schedule of what was expected of a company one quarter out the gate in terms of our free cash flow margin. And at the end, what matters is how much cash is a business generating. And we're excited to show that relatively early on, we're able to actually generate cash for the business, which is great. But you should expect our stock burn to go down over time, because $500 million is not sustainable. And so I hope to certainly beat that in Q2, in our Q3 earnings report and moving forward.
Yeah, well, the street's certainly loving it right now, up more than 20% on the market right now. That's not bad.
I had another. Okay.
Well, now you know. Talk to me about keeping up the momentum, though, because it always is that sort of, that spotlight on you, the sort of shakiness of getting out the gate and then keeping up that momentum. We've seen companies, start off strong and then maybe plateau over time. So what can you tell us about how you're planning on keeping up that momentum?
That's a great question, because look, we had a strong quarter, but that's just one quarter, and we largely baked this quarter a while ago through the efforts that we've made here at the company. And we recognize that we want to build a company that's going to become an iconic organization that lasts long term, and that's going to require sustainable growth over a long period of time, not just one quarter. That's why we try not to look at the numbers, the stock price, how it gyrates, up and down on any given day. And we try to remain paranoid. We're a founder-led company, and we think long term. This company, in all of our meetings, we're constantly thinking long term and try to be very intellectually honest in the products we bring to market, and our go-to-market strategies, in our where we spend our money, and we're evaluating the business, up and down. And so I'm confident of what we got in the pipeline, as well as the runway ahead of us. We are about a $500 million run rate for digital physical therapy for what we believe is a $70 billion market. So a lot of runway in digital physical therapy. But this model of applying software and connected hardware to automate the delivery of care itself is a model we want to apply to other areas of healthcare. And so you're going to see us over time peeling away more aspects of in-person care and using technology to automate, say, 60-70% of it in version 1, with the aim of getting to where we are today with digital physical therapy, where we've automated away about 95% of provider interactions. And what's exciting about healthcare is that, just about every market that you look at in healthcare is $10-20+ billion. And so it is even relatively small markets in healthcare are really big TAMs and give us a big opportunity to have an impact on patient outcomes as well as cost reduction.
Yeah, absolutely. Well, we're going to have to bring you back at the end of the next quarter to see how this all pans out. Daniel Perez, CEO of Hinge Health, thank you so much for joining us.
Thank you, Anjali.
Don't go anywhere. More market catalysts coming up right up.
President Trump unveiled an additional 25% tariff against goods imported from India over the country's imports of Russian oil. Here were the details. Washington correspondent Ben Werschkul, and this was something that the president had been sort of threatening over the past couple of days. Now we get the actual executive order or letter about this, right?
Correct. Yeah. So the full text of the order is released. The order does specifically say that these additional 25% duties do stack on top of existing duties. And what that means kind of overall is that India is facing 50% tariffs if everything Trump has promised goes into effect in the weeks ahead. The key fact here on terms of these additional 25% tariffs is a 21-day delay on them going into effect. So there's a 3-week period where before these go in, and then there's an additional delay in terms of goods being loaded onto boats, which means the full weight of this order wouldn't be felt until September. I think the way to think about this is kind of a part of a larger piece of Trump's efforts to end the war in Ukraine. We've seen his envoy, Steve Witkoff, is in Moscow this week talking to Vladimir Putin. The Trump strategy they've talked about is direct pressure on Putin, but also get Russia's allies to weigh in, essentially have Prime Minister Narendra Modi call Putin to pressure him on that level to end the war. So I think it's what we're seeing. How that shakes out in the coming days remains to be seen, but we'll have a 3-week period before this additional 25% duty goes into effect. Worth noting that the 25% duties, the first tranche on India, are scheduled to go into effect this week. That is at midnight tonight. These are the reciprocal tariffs that India is facing. Trump is sort of pushing these additional Russian oil tariffs on a kind of different track, but they all will add up together if nothing changes to a 50% duty in the weeks ahead.
So that if nothing changes is important, Ben, because given that there is a delay, there is the possibility for some sort of agreement to be reached, I guess in theory.
Absolutely. The deadline for Russia is this Friday for Vladimir Putin to agree to a truce or face sanctions himself. The details of that aren't being determined, but these would be sanctions on Russia itself. So it's clearly part of a concerted pressure campaign. If that doesn't work out this week, then these India tariffs become much more likely to go into place. But if a ceasefire is announced and Trump can declare victory there, it clearly means these additional 25% duties are less likely to go into effect in 3 weeks' time.
Ben, thank you so much for walking us through that.
Mm-hmm.
Now time for some of today's trending tickers. We are watching Capri, Lucid, and Toast. First up, Capri, the parent company of Versace and Michael Kors, reported better than expected revenue for the first quarter. It also gave a top-line forecast for the second quarter that also bested expectations. Joining us for more, Yahoo Finance's Brooke DePalma. Those shares up 10%, Brooke.
Julie, lots of momentum this morning when it comes to Capri Holdings, but let's say it straight that these were pretty low expectations that the company had to beat. And so certainly investors pleased that they did in fact beat that with a better start to their new fiscal year. Also that raised fiscal year 2026 sales guidance as well. And if you take a look though, compared to a year ago, these shares are still down more than 37%. And that's really due to a lot of change up at the company. Back in April, they did see the exit of their CFO and COO, Tom Edwards, who was a longtime executive. They also did agree to sell Versace to Prada for $1.375 billion back in April. And a year ago, back in November, they did have that failed attempt to acquire Capri, or rather, failed acquisition of a Capri by Tapestry Brands. And so they were Tapestry Brands looking to buy Capri. That ended up falling through. That certainly impacted the stock. And so hopefully we're seeing some momentum as the company really looks to turn around, of course, behind brands like Michael Kors.
Yeah, we'll see. And then let's talk about Lucid, which is going in the opposite direction. The EV maker lowering its production forecast for the year. Its second quarter results were worse than estimated. The shares taking a hit today of about 8%, and they're down on the year by almost 27%, Brooke.
Yeah, certainly not the story that Wall Street was looking to hear this morning. What exactly we're seeing now from investors, they're saying that they're really looking for more signs of accelerating momentum for the company after, quite frankly, not hearing signs of momentum. They did, in fact, cut that expectations for 2025 guidance for a range of 18,000 to 20,000, down from the previously expected 20,000. And TD Cowen saying in a note this morning that the key now is for Lucid to execute a successful second half of the year on that key SUV Gravity, the ramp up there, while maintaining a healthy liquidity runway to successfully launch what it says was a mid-sized platform in the second half of 2026. And so they're looking for key signs of momentum. We know that this stock is under pressure over the year and especially year to date as well. But once again, this morning, shares of that down nearly 8.5%.
And let's get to Toast finally. The restaurant-focused software company out with second quarter results. It gave an outlook that analysts see as slightly weak, although they noted it could be conservative. And unlike Lucid, which has fallen this year, Toast was actually running into these results, Brooke.
Yeah, going into these results, the stock already somewhat priced in the momentum that we've seen so far this year. The stock is up nearly 21% year to date. And I like the way the OneNote from Evercore phrased it. They said that the inflection point has arrived early. And that's why you're seeing a bit of a pullback here this morning. They noted that when you think about the forward PE ratio here, it's at 50.76. They said the stock is trading at a high premium multiple. And they see the debate sharpening and prefer to stay on the sidelines here. Of course, Toast also has to do with the restaurant industry, and we see that come under pressure lately. And so it'll be interesting to see the way that this company is able to really make way into what exactly is next in order to ramp up excitement for investors here.
Thanks, Brooke. Appreciate it. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, Bitcoin is pulling back from recent record highs, hovering just below $115,000 this morning. Polymarket, by the way, pricing in a 53% chance that Bitcoin dips below $100,000 by the end of the year. My next guest says this could be a combination of risk-off sentiment and seasonality, potentially weighing on crypto. Joining me now, Stephen McClurg, Canary Capital founder and CEO, is joining me in the studio. Good to see you.
Good to see you, Julie.
So what do you think, below $100,000 by the end of the year?
I think it's entirely possible. We have a lot of great tailwinds that's pushing Bitcoin up, probably to about 140, 150,000. But it's highly possible that we see Bitcoin below 100,000 at some point, if not now, as in the next 30 days, or by the end of the year.
What is driving Bitcoin at this point, right? Because all this year, the narrative in the first half of the year was really all around regulation, loosening, people coming into the market, institutional adoption continuing. But now all that stuff is kind of behind us. Exactly. So now what?
Well, I mean, look, and if you think about it, a year ago, Bitcoin was in $40,000 range. So the fact that it's gone so high, so fast, 3x in the last year, is quite significant. So there is a bit of reversion to the mean here.
Gotcha. Okay. And the other thing that I find interesting about Bitcoin is, you know, in the earlier days, I guess, it was seen as sort of this thing that didn't correlate to anything. Mm-hmm. But now it seems like it is sort of a risk on asset to some degree, right? And so we've seen some money coming out of it recently. So how should investors be thinking about it in that way and where it belongs in the portfolio?
Sure. Well, when I was in traditional finance, before people were heavily invested in things like cryptocurrencies, we looked at what correlated to inflation. And a lot of people look at things like tips or gold. And the reality is gold isn't very well correlated to inflation. Tips aren't well correlated either. Equities are actually the best correlation to inflation. So if you expect inflation, it's a great time to buy equities. Cryptocurrencies have fallen to that category as well as a risk asset. So not only As a risk asset, is it following equities in some areas? It also closely follows global M2 supply. And we see a very strong correlation between Bitcoin and global M2 monetary supply.
And we've been talking about Bitcoin, but I guess I should ask you about other stuff as well. We've seen Ethereum in particular catch a bid recently, sort of catching up with Bitcoin to some extent. So where are you spending your time these days?
I'm spending most of my time in actually Bitcoin, but a lot of times in other cryptocurrencies as well, such as protocols. Not so much Ethereum, but some of the other newer ones that are fast and a little bit more efficient. So we're looking at things like SWI and XRP and HBAR. Those are some of the ones we're looking at. Litecoin is something that's very similar to Bitcoin that is gaining favor again, and we're a big fan of Litecoin at this point.
What do you do with this stuff that you can't do with Bitcoin?
Yeah, absolutely. And they're two very different things, right? So Bitcoin, I see it as a commodity, as money, and you use it for transactions. And in other countries, you do it a lot more, and here you do it some, but I use it for transactions all the time. Litecoin is very similar to Bitcoin, except it's faster, it's a little cheaper. It's almost like the silver to Bitcoin's gold, which is something what we like, and it's actually more usable in smaller transactions, if that makes sense. But all these other ones are protocols, and the way that I think about that is, if you have an iPhone, for instance, or any other kind of smartphone, you have all these different applications on there. And if you're playing games like Candy Crush and you run out of time, you have to buy more time, and you have an in-app currency that does that. So things like Ethereum I see that as kind of like an iPhone. It's got all these applications built on top of it, and you use ETH as a currency to power those transactions. So it's very different. It's a currency, not in the same way that Bitcoin is. Bitcoin is a currency more like the dollar is.
So it's almost purpose-built for whatever it's in. Another trend I want to ask you about is the treasury trend. That is companies putting various cryptocurrencies on their balance sheet. Obviously, Strategy, aka formerly known as MicroStrategy, really pioneered that. Michael Novogratz of Galaxy Digital, who provides a lot of services to companies doing this, on his conference call yesterday said, I think we might have reached the peak of companies jumping on this trend for now.
Yeah, I agree. I think we're getting very close on that. And the reality is this is a good thing because companies can choose a currency like Bitcoin to hold, just like you hold foreign currency reserves as a company that transacts in other countries. With Bitcoin, it's almost like if you're transacting in the digital economy, this is a smart move to hold Bitcoin on your balance sheet in order for future transactions, to think about it like that.
But if you're an investor, do you think it is better to buy Bitcoin itself, spot Bitcoin ETF, a company that holds Bitcoin? I mean, isn't it best to just do it as directly as you can?
I agree. I would rather own, coming to Bitcoin, I'd rather own spot directly first, an ETF second, and then a treasury company third. And the issue with the treasury companies is they do trade at premiums. But what will happen is if Bitcoin really starts dropping in price, which it does every 4 years, and I expect it to happen in 2026, that as the price of Bitcoin drops, it might trigger some of the convertible notes and preferreds that they are issuing to buy the Bitcoin, which might cause them to forcibly sell the Bitcoin.
Right.
So anytime you have a leverage play, leverage works both ways, and we worry about that leverage.
So 2026, do you think that's when we're going to see the next more significant pullback?
I really do.
Okay, it does tend to happen on time, I guess, when it comes to Bitcoin. Stephen, thank you so much for coming in. Appreciate it.
Thank you so much for having me.
We got much more markets action coming up, including earnings from Dine Brands and that company's CEO. You're watching Market Catalysts. Shares of AI-powered consumer lending company Upstart are falling despite the company beating analyst expectations for earnings and issuing upbeat guidance. Here to dive into the report is Dave Gerard, Upstart's CEO. Dave, it's good to see you. Thanks for joining us.
Thanks, Julie.
So let's just talk big picture about the quarter here. You guys reported an increase in adjusted EBITDA here. You also saw an uptick in your transaction volume, a big one. So what were some of the trends driving that?
Yeah, really, we've had some pretty dramatic improvements in our AI models. They lead to better conversions, which went up a lot this quarter. In the end, it led to over 102% revenue growth year on year. It led to a return to GAAP profitability. 92% of the loans on our platform were fully automated, so approved in an instant, and no human involvement in making those loans. So all the things with regard to our AI platform are just all moving in the right direction. Most of our funding on our platform is coming in the form of long-term partnerships with private credit, as well as kind of reaching a new high in terms of bank and credit union funding. So all things are great. The reaction of the market is hard to speak to, but we kind of know in the long run, if we keep building the business the right way, the stock will obviously react to that over the long haul.
I did see some discussion that maybe, because of some of the other competitors in the market reporting big numbers as well, that it's tough to sort of, maybe people were looking for a higher bar even. Can you talk me through competition a little bit and how you guys are trying to do those conversions and stand out against some of your competitors?
Yeah, sure. Well, I'll say, first of all, 102% year-on-year growth. I'm not sure there's anybody else growing at triple digits in the industry. So, but credit is an enormous market. Trillions of dollars originated each year, and there's a lot of room for a lot of success. So this is not exactly like, I don't know, Uber and Lyft or somebody else like sniping at each Hertz and Avis. This is a very, very large market where there are very few companies focused on AI as the enabler to make a far better product, to reduce the risk of lending, make it much more profitable for banks and credit unions. So we're pretty unique in that area. I don't think of competition as being a real constraint on us today, given none of us have more than a rounding error of market share in any of the categories we're in. And I think the opportunity for enormous growth, we are growing very quickly in our newest categories, home and auto, which grew 67%, 87% sequentially. So growing extremely rapidly. And the reason behind all of that is because AI makes a radically better product for the consumer. You're approved in an instant. You don't have to go sit in front of a loan officer. You don't have to upload documents or get on the phone. And that sort of experience, along with the best rate you can get, is the kind of thing AI can do. So we feel really good about our position in the market and our opportunity for growth in the coming quarters and years.
So when you talk about the conversion rate, that's the people who come looking for a loan and who actually take the loan, right? Who actually pull the trigger on the loan, right? So when you talk about AI helping with the conversion, is it just the things that you were just describing, sort of speed and ease of the process, or are there other things, other ways that AI is helping you sort of close the deal with folks?
Yeah, that's a great question. Conversion really is, it's the number of people that request a rate or request a loan that end up getting the loan at the end. And it gets better when we can approve more people, which a smarter model can separate good risk from bad risk, and that on the margin will approve more people. It gets better when we reduce friction and can approve somebody in a moment. If somebody is approved very quickly, they'll, more than 90% of the time, they will accept that loan. If you send them off to gather documents and go through a process, we find that, the conversion rate falls pretty dramatically. It's about a third as much. So this is what AI does. It just makes a better product that leads to higher conversions. And that's been the fundamental way that we've grown year to year.
Dave, I want to talk about the end markets for the stuff that people are taking loans out for, right? When you're talking about cars, it's obviously been a pretty volatile market in part because of tariffs. The housing market has been challenged. So how is that demand that maybe has been a little bit pressured translating for you guys? Or put another way, what's your vision or what's your line of sight into those end markets?
Yeah, sure. The demand for credit, at least from our perspective, pretty much never softens. It's always there. It's always strong. And, the question is, how much of it can we responsibly serve? And I think, we do a good job of that. For sure, prices are high. Interest rates are passed through our product onto consumers. And the risk in the market continues to be high. Across all flavors of credit, default rates are still, whether you're talking about credit cards, mortgages, student loans, auto loans, they are significantly higher than they were before COVID. And that means, if people like us have accommodated that, that means the prices are high to consumers. So yeah, there's a lot of things that could, looking forward, get better. For us, we really care about the financial health of the American consumer. And that means just to make sure they're making more than they're spending, that their savings rate goes back up. When those things return to what we would consider a more normal state, which really kind of means 2019 and prior to that, we'll all be in a much better place. And our business will be a lot larger because right now we are pricing a lot of risk and higher interest rates into, and we don't really have a choice in that, into the loans that we provide to consumers.
Dave, thanks a lot for joining us and giving us some insight into the quarter. Appreciate it.
Thanks, Julie.
Got more markets action coming up. Stay tuned. You're watching Market Catalysts. Dine Brands reporting mixed second quarter results. The parent company of Applebee's and IHOP missing adjusted earnings per share estimates, but beating on revenue. Joining me now, John Payton, Dine Brands CEO. John, thanks for joining us. You noted in the release and in the call that you're seeing a strong response to value. So talk to us about what that means and how you're trying to offer that to your customers.
That's right, Julie. We did have a strong response to value. Both IHOP and Applebee's have got continuing momentum through the first 6 months of this year. You know, Applebee's specifically focused on our 2 for $25 menu. That's 2 entrees and an appetizer for $25. And we were consistent in hammering that message during the first 6 months of the year. And in addition, we introduced a new entree every quarter. So we started out with a new pasta dish, followed by sizzling steak, followed by chicken parm. And that combination of 2 for $25 and the new entrees really resonated. Over at IHOP, we've got House Faves, which is 4 all-you-can-eat, 4 entrees for $6, $7 on the coasts. And we've been hammering that message for the last 9 months, and that drove traffic, beating Black Box for the first time in a couple of years for the first 2 quarters of this year.
What effect did all of that offering of value have on your margins, John? And I guess, at least for now, you're seeing this as worth it to get volume through the door.
Yeah, each and every promotion that we do or a limited time offer, they're profitable. They're designed to be profitable, and they're designed in partnership with our franchisees. And so the most important thing is they were driving new customers to our restaurants and to our off-premise business during the quarter. Average ticket increased as well as revenue. So they were very successful in terms of what we set out to do.
Now, I know that Applebee's comparable sales were up 4.9%. IHOP's were down 2.3%. Why do you think you saw the divergence between the two?
Well, when we look at the 2 categories, we do look at family dining, which is the category that IHOP competes in. And it is true that in that category and IHOP over the last couple of years, they did raise prices a bit more than Applebee's did over the last several years. And so we've been seeing our customers catch up to that. We're now at the point where IHOP pricing has fallen back into the historical 2 to 3% range. But the most important thing is that the House Faves program that we started last year is driving traffic each and every month into the restaurant. And so that was sort of phase 1, is to put out that program and demonstrate that we could drive traffic. It was so successful, Julie, that our franchisees agreed to extend it from 5 days a week to 7 days a week starting this fall because of the incremental traffic that it's driving. And now we're working on what we call a barbell strategy, which is to make sure that when guests come into the restaurant, they see some of our more higher priced items like the pancake of the moment and our omelets, and we make sure that we're managing check that way.
And John, all of this tells me that the consumer right now is prioritizing value, right? So what does that tell you about consumer confidence out there? And historically, is there sort of a line between, okay, people want to save money but still go out, and no, I don't want to go out at all, I'd rather eat at home where it's cheaper? Where is that sort of dividing line?
We're on the other side of that dividing line, which is good, is that it's very competitive, but when guests still want to leave their home to dine, and you've got to work really hard to make sure that they spend their dollars with you. And what we're seeing in our guests overall, typically Applebee's and IHOP guests earn under $100,000 a year, and they definitely are feeling the pinch on their wallet, and they're managing it closely. But we're encouraged by a couple of things. At Applebee's, for example, we saw fewer of our lower income guests leave for less expensive options. And we saw more higher income guests join us during the quarter, which is part of what drove our traffic. We also take a look at the percentage of our tickets that are the value components of our menu, like 2 for $25 or House Faves or our limited time offers. And the share of tickets during the quarter that were value oriented declined a little bit, which tells us that our guests are getting a little bit more confident in dining out. And when they do dine out, they're dining with us because we think we have the right value messages in 2 for $25 and House Fave right now.
John, thank you so much for joining us. Appreciate it.
Thank you, Julie. Take care.
You too. And that is it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.